So today we are going to be talking about fundraising. This is our second webinar. Our first webinar was bookkeeping for startups a few weeks ago. Today's topic is thankfully a lot more interesting. And we have Bob Bates here with us. Bob is a fundraising expert on our platform, Affine Finance. And we can dive right in. Bob, do you want to maybe introduce yourself?
Sure. Thanks, Aaron. Good morning,
Sure.
everyone. My name is Bob Bates, and I'm a CPA, and I've been a CFO for small and mid-sized public and private companies for over 25 years. I've raised over $35 million, and I've bought and sold companies, valued them, done turnarounds, been audited, pretty much everything that a CFO could do at one time or another.
Great, great. So why don't we dive right in? So Bob, if you maybe if you can kick off with giving us just a very brief overview of what the process looks like for seed and Series A startups, the fundraising process, like to a point where they realize they need to go out to market and start fundraising. And what are the first couple of steps they take? How do they think about strategy, and how do they think about how to approach investors, when to approach investors, who to approach, and whatnot?
Sure. Yeah, so the planning is important. You've got to have goals. You've got to know why you need the money, what you're going to use the money for. Is it building your first version? Is it going to market? You've got to determine a timeline. You've got to have goals. You've got to create a budget. You've got to research the various investors that you think might be appropriate to approach, and you've got to put a pitch deck together, and you've got to be prepared to that this process is going to take a little while, so it could be 3 to 12 plus months.
Got it. And when should founders start thinking about raising a funding round? Is it, a lot of founders that we have come across, basically with Affine Finance, generally come to us when it's, too late, when, they're running out of cash and they're on the brink of, like essentially blowing up. So I think that is, and then on the other hand, you don't want founders don't want to be fundraising all the time, right? So if they have a good cash position, they don't want to be continuously going out and meeting investors instead of running their businesses. So what is the sweet spot? Like when would you recommend founders start thinking about, going to market?
Sure, yeah, I think before they need the money, because they've got to realize that the process is going to take some time. So hopefully they've been able to bootstrap things till this point, maybe get some money from family and friends.
Got it. Okay, perfect. And can you maybe walk us through like a recent fundraising advisory experience that you've had, and the specific circumstances around how the founders thought about fundraising? How did you guys plan strategy? How did you guys go to market?
Yeah, so I had worked on an IoT play. It was in the retail space, and so it was the same process that I had described, really. It was making sure that we knew who was going, it was a good team, it was a good concept, putting together the pitch deck, getting into an incubator, doing the pitches, uh, going around and yeah, going through that process.
Got it. And what was your like how were you involved in that process? So you came in as an external advisor, you were helping the founders essentially go through the process. So were you essentially helping them do the hands-on dirty work, or were you actually just giving advice, and was it mostly the founders who were doing all the work? Like how did the relationship look like?
Well, in that case, it was a little bit different because I had worked with some of them in other projects for many years, and I was the one local here in Silicon Valley, and so it was easier for me to do some of the pitches, and then when we had some kind of high profile events, we did a couple of pitches in New York to, I think it was almost 1,000 investors and in one sitting one big room. And so the CEO did one of those and I did the other one because they were different on different dates. And then the same thing for locally here. He came in and some other people had come in as well. So it was a good yeah. So I was involved with the um, with a lot of the local meetings because it was just easier geographically from a time zone standpoint and so forth.
Got it. Okay, that makes a lot of sense. So you're going to be jumping around a little bit. The questions that I have are all over the place a little bit. So maybe let me jump into like, again, going back to when founders start thinking about fundraising. So, for a lot of founders, VC is generally not, venture capital money is generally not the most, applicable, I guess, funding vehicle. So what are some other alternate sources of capital that, you think that founders should also, that are underappreciated, that founders should also consider?
Um, well, I think that like I mentioned the family and friends and in the seed round you can some companies have done crowdfunding of some types. There's even I talked to a UK firm recently and they had I had mentioned to them we were talking about grants and it just depends on what the company is doing. And then of course angels is probably the place where most startups start is assuming that they've gotten to, they have a product, they have a little bit of traction.
Got it. Yeah. And then I think one thing that, we get asked a lot about is debt. So you obviously have like a whole range of debt, right? Like you have inventory loans, financing loans, venture debt. I don't know if you have a lot of experience with that, but that's something that, at least in my opinion, founders are generally confused about a lot of times, like how to think about debt, how to think about debt versus equity, how to think about cost of debt versus cost of equity. So that's also something that I think a lot of founders probably don't you know think through that well.
Yeah, I actually have a lot more experience with debt as it would be, and so um, yeah, and I think that a lot of founders don't want to deal with that, but it is an option. I mean, there's everything from um, from merchant financing, which is extremely expensive, but
Right.
on up and it would typically with a startup it would typically involve some type of personal guarantee because there's no assets, there's no um, profits yet. Although I will say that there's so many specialty niches that like I was just talking to we had before we just sold a GPS company, and for that we were looking at some financing options where this particular lender only works with SaaS companies. So um, there's specialties for everything really.
Got it. Okay, great. And okay, and then just going back, like, to the entire process overall, how long should a founder budget? How much time should somebody plan to run their seed or Series A process for? Is it a month, 2 months, 4 months, 5 months? Do you have any experience with, like typical fundraising process timelines?
Well, I mentioned briefly like 3 to 12 months. That's a pretty wide range. So there might be 3 to 12 plus. So there might be an average of a little bit less than that. But some of that's
Right.
also assuming an experience, like an experienced founder or some experienced people that are experienced in fundraising. And so It's you have to be realistic. You have to remember the statistics that it's a lot of companies don't make it. If you have a great idea, then
Uh-huh.
it could just be very quick.
Got it. Okay, makes sense. And do you see like the timeline varying as you go up, like, between an angel and a seed round, a seed and Series A and Series B? Do you see the process taking longer for later stages or shorter for later stages?
Well, I think it depends. The due diligence can be more substantial if there's more money involved, but at the same time, if you've raised money from VCA in the past and you're B round and you're working with the same investors and they already know you and you've been reporting to them and
Yeah,
communicating and progressing, then it could be a shorter time.
got it. Okay, no, that makes sense. And then what are some common questions that, investors generally ask in a seed round, both like initially as well as in a deeper due diligence? And these are mostly companies assuming they don't have, a lot of data, a lot of sales data, a lot of historical data, so the due diligence would be fairly short. But how do they, like, what questions do they ask, and what are some of the factors that go into their decisions?
Yeah, well, let me answer that by kind of saying bring up the pitch deck because that's really the one of the most important things here, at least especially to get the meetings. And so, and the pitch deck is going to answer all of those questions. So it's going to have there's a certain, in the value, I mean, there's recommended models for how the pitch deck is set up, and you can deviate a little bit, but and I'll maybe say some of this out of order, but you should start with what problem are you solving? What is the product? What is the size of the market? What is what is the business model? How are you going to make money? What are the successes that you've had? What traction and then going into the team, what are the prior successes? What's the raise? What's the use of funds? And what's a use case? Give a quick example of a customer that you have and how they've used your product.
Got it. Okay. And then generally, like, so your pitch deck would answer a lot of your initial questions that the investor would have. Are there any like curveballs that you've seen during your career that investors asking for unreasonable things or asking for things that, would take founders a lot of time to either model out or process?
Well, I don't. I think for the most part, it's probably not unreasonable. I remember being at an exhibit and we had a patent and we had done some research on what we thought the value of it was, and the potential investor wanted just the number of the patent, and then so I mean we didn't necessarily have that with us, but that was something easy to get. And then after we researched it, then it turned into this huge uh, Q&A session just on that. And so sometimes you may not have you may have to do a bit of research in order to answer the questions. But if you have some type of a use case at least, then for the service, for the idea, then you can try to apply that to other situations.
Got it. Okay. That's great. And then what are some of the best practices and common mistakes that you would say? Maybe we can take both questions separately. Some best practices for, say, startups to run around. Essentially, what should they do? What have previous startups done successfully in the past that startups who want to do fundraise can copy in the future to make their round more efficient?
Well, I think it goes back to those initial items, that if your process is good, if you have good planning and you know what your timeline is, you've created a budget or a model, and you've researched the investors, and you have a pitch deck, you do your pitch as well. I think those are the important things. I think that I guess researching the investors is one that a couple of the times where I did this, and I spent a lot of time. I also did a crowdfunding one, meaning it was a crowdfund, it was a financial company, and we were going to angels. And I think both times we just showed up at all these random pitches and just and there was various people there, various investors, and so it wasn't as targeted. And but I know some other startups that um, some of them have been quite successful that don't want to deal with these large events. They just feel like there's too much competition there. They'd rather just go to the investors that they've selected directly. And so that's something to think about, which one works for you, because you never know. There's some investors that invest in certain spaces. Like we found ones that had invested in retail and invested in maybe a competitor. Like one was like a strobe, things that track customers going in and out of the stores. And so on the one hand, it was good to talk to somebody familiar with the space, but on the other hand, it could be that they already are too concentrated in that area, and so they want to invest in other things. So, but some investors will invest in anything that if they like the founders and they like the idea, then they'll invest in pretty much anything. Maybe they stay away from healthcare, or there's ones that do only healthcare, but or whatever the case might be. But
Okay, got it. And so in a nutshell, it's basically like selecting the investors you want to target, not being afraid of like, going to these large shows, and also doing some due diligence on the people you reach out to, right? So making sure that it's a right fit, so you're not wasting their time and they're not wasting your time. Um, okay. One other thing that I would like to point out to the audience here, we do have like a tools resources guide. It should be on the top of the video screen here. So definitely, take a minute to download it. This is not these are not like process recommendations, but these are actually software tools that we have compiled that may help you do a fundraising round. Okay, great. And then maybe asking the inverse question, Bob, like what are the mistakes, some of the common mistakes that startups make when fundraising? Like, I think one thing that does stand out is, obviously you mentioned in your best practices, which is target the right investors. So, one thing I'm assuming would be targeting the wrong investors, right? Like targeting investors that are not a good fit for them. But any other common mistakes that have stood out in your, during your tenure that you would recommend startups to avoid?
well, it's easy to overspend while you're trying to raise money. So obviously you have to try to address that. Make sure that your team is solid. You don't have problems with that, or with the raise process itself. That you don't want to. You have to balance. You don't want to spend all your time on the raise, but at the same time, the more you put in, the more you might get out. So it's a delicate balance. You've got to, maybe there's somebody on the team who's a good speaker, who's done this before, who's good at presentations, who wants to be the one to do the pitches. If you find that dedicated person, then that can the other areas, I guess, when if you're successful and you get offers, um, there's some finesse involved with that. You want to there's it's a relationship, right? Like and so there's push and pull, but you don't want to be too demanding. I remember getting some advice from VC saying that if they're offering a particular type of an investment, if if it's somewhat reasonable and if it fits, then you should take it. You don't want to scare them away with, having, let's say that you have a lawyer and trying to change all the terms, and it's and then the other thing in that same time frame is how much equity are you giving up? So you don't want to give up too much too soon, because chances are that you're going to have to go back and raise more, and you're going to need more equity later, and you've also diluted yourselves too if you do that.
Got it. Okay, well, that makes sense. And how should founders think about strategic versus financial? I think that question comes up a lot, with the companies that we work with. Should I just take money where it's available, or should I be more targeted? Should I, think about investors that will add value to me in the long term? Ideally, you would find investors that would, bring more to the table than just money. But then you also have the other end of the spectrum where you have corporate venture capital, you have, large companies, both domestic and international, that are, deploying capital in startups. So how should founders think about, financial, strategic, who brings value to the table, what value do they bring, and how do they, essentially tackle all of this during fundraising?
Yeah, well, of course, it's hard to turn down money when you're trying to get things started. So it's um, it's a trade-off. I think that you can't expect to get everything from one investor. I mean, obviously, there's incubators out there, whether it's 500 startups or Y Combinator, whatever. There's tons of them around, and some of them will provide a lot of these things. The ones I was in, they're um, providing advice. They're bringing in advisors that and doing presentation, advisors that may not even be investors. So as long as you can get everything that you need from somewhere, it doesn't all have to be from the investor. So if it's a small angel that just wants to put in money and just get updates periodically, and not, maybe they aren't a specialist in that area, and they can't really add a lot of value, then maybe you get an outside advisor from somewhere else that can do those things. And as far as you had mentioned about the international, I mean, that's, yeah, if people are approaching you, then that's great. I think there's one thing to consider, just with when you go outside of the U.S. legal system. Then you may have documents that are, and of course the money's in a foreign currency, but documents in a different country's legal framework. So does that mean, if it's coming from Europe, do you have to then hire a lawyer over there? So it's just things to consider. But um, again, you don't want to close too many doors too early.
Got it. And how would you, I think for a lot of um, Asian companies are rapidly deploying capital in Silicon Valley. And I think one thing that they bring to the table is manufacturing expertise, especially for hardware startups and supply chain and whatnot. So have you seen that play out? Like that is the pitch that we have seen, companies make to startups, but have you seen that play out in practice, after, or is that something beyond an advisor scope? Because this would be after the capital is deployed. I guess the question is, do they follow through with their promises on, manufacturing assistance, supply chain assistance, and whatnot?
Well, I've seen more of the earlier parts, where I was at a pitch where there was a group of Chinese investors that had come over just to hear the pitches, and so and some of the people pitching didn't know that they were going to be there, and some of them did, and there was a translator, so it was they were very serious about it, and I don't know which ones they invested in, but um, that's true. They do have the manufacturing um, expertise and um, and other expertise. I mean, I was working with a company just recently that was trying out like Alibaba, bringing things over here and then selling it like on an e-commerce type platform. And so, um, yeah, I don't know that as far as the end result. I guess that's an interesting question. It would have to be um, looked at. It's probably different from different stories from different people. Different, some have successes and but definitely Asia is definitely yeah, where a lot of money is coming from.
Got it. Okay, makes sense. And how should founders think about, when you are taking money from investors, you want to have a long-term relationship with them. You want them to participate in your future rounds. You want them to, be available when you need advice. So how should founders, I guess, think about and even question their investors if they would be willing to participate in future rounds? So I think a lot of the traditional VC funds, I mean, they're open book. You can go up and look at their historical track record and see like, how many companies that they invested in, and then again participated in their future rounds. But for any investor who is not that well known, who's not that well documented, how do you approach that topic, and how do you, I guess, do your diligence on that topic?
Well, I think that one way to increase the likelihood that an investor is going to invest in future rounds is to make sure that you've communicated well with them and that you're making progress. And so I think that yeah, that really increases your odds there, and making sure that I mean it's something that you can ask when you're in the due diligence state before they've invested at all, but it's but you don't want to be putting pressure on them because they're the ones that really are trying to do the due diligence on you, and so it's you just got to make sure that you understand that relationship. There, like I said before, there is some give and take, and you don't want to be pushover, but at the same time, you've got to satisfy them and get that first check written, and then you have a little bit more ability to you've got a little bit more power. You have a little bit more control after that.
Okay, great. So we have like a few more questions, and then we have a lot of audience questions rolling in. So I'm going to ask you like, I guess, two more of my questions and then switch to the audience Q&A. So one question that, a lot of founders often get confused about is, how should they structure the round? Should it be a convertible note? Should it be a safe? Should they price the round and make it an equity round? So how would you, I guess, how do you generally recommend founders approach this?
Well, the safes are newer in the last couple of years because some of the investors they're finding out that you're supposed to have a lending license in order to do convertible debt, and so since most of them don't, that the safe was a good creation to get around that because you've got the issues of like with a typical traditional loan, which is the case for convertible debt, you've got the terms, the amount of time and the dollar amount. So um, yeah, so safes are a good option. It's like the option to buy the stock later. So it's a type of an option. And so um, but I would go back to I would what I said before about being flexible and letting the investor take the lead on that, and unless there's just some compelling reason that you have to do it a certain way. But if you have a lawyer or somebody telling you that, then I would try to maybe get a second opinion or really think about, ask them why they're saying that.
Got it. And I think this kind of extends to the question of, valuation, and obviously that's a very touchy topic. Um, you, how should you think about valuing a startup? Like, is it something that you in initially and then negotiate with your investors, or is it something that your lead investor determines for you? Like, how have you generally seen startups approach valuation, especially if they're pricing around?
Well, I think you have to have a number in mind, and that number has to be reasonable. And in the Silicon Valley startup space, I think you see a lot of valuations in the same range when they're kind of pre-market. They, and it could be anywhere from like under a million up to several $1 million. So, and then the amount of the raise may be determined by that. But then there's companies that if it's hardware, if there's some big need for a big budget in order to get to scale, then you're going to see a different approach. You might see somebody trying to raise several $1 million out of the gate, whereas it might be easier just to raise a couple 100,000.
Got it. Okay. And my last question for you, which is also an audience question here, is, how do you typically work with startups? And if they were to work with, you through Affine Finance, how would the relationship look like? Like, would it be an advisory relationship? Would you be helping them build the tech, the model? Um, and it could be any or all of the above.
Yeah, well, I think that reviewing the business plan, reviewing the model, uh, those are important things. Making sure that if they need help on figuring out who to approach, where to pitch, those things are all important. I will say that um, especially early on, I found it's important to have your presentation in different formats. So um, you've got a 30-second pitch, you've got a 1 minute pitch, you've got a 2 minute pitch, you've got a 10-minute pitch, and then you're able to also be able to talk for an hour or two when you get to that point about the product. So some of it is technical, some of it is financial, some of it is strategic. It can even, yeah, talk about the role of the lawyer, the role of the bookkeeper, the people that sort of interface with because it's think of it as like either like an interim CFO or like as well, and so those things are important. So and you might even have one that so it's a overall financial advisor that is in this context focusing more on the fundraising, but understanding a little bit about the other parts of the company because that's what the investors are going to want to know. So it's like a trial run.
Okay, great. Um, okay, so let me start with an audience question now. So, one of our audience members has a question. One of the tools that we have recommended in our fundraising guide is Crunchbase Pro. We use it extensively here, and we find it great. It has a lot of data. The data is not, it's mostly great. There's a lot of, there's some issues, but for the most part, it's usable. But I guess the question here is, do you have any experience with any other platforms such as PitchBook or Preqin, and which platform do you recommend to do your investor research?
Yeah, there's a bunch. I was just looking at one yesterday. Let's see if I can find it. But I would say that I've used Gust before, Gust. It's really good because there you have your pitch deck and you just press the button and it goes out to the investors that you want it to go to. Angel is obviously a big site. Um, there's just so many tools out there that yeah, I've heard good things about Crunchbase. I haven't spent as much time with it, but yeah. So I would definitely try to find some tools that you like and use a couple of them and
Yep.
take it
And
take it from, oh, founder suite, suite SUITE. So
mhm,
and I haven't gotten too far into it, but
mhm.
it looks good. So
Yeah, we have like in our resources guide, we also have Founder Suite mentioned, and we actually have a discount code as well. So we have a partnership with Founder Suite, and we will have his CEO come and talk about their CEO come and talk about Founder Suite, I think in a few weeks from now. So yeah, great. The one thing I would mention, since PitchBook was asked specifically, is I have used PitchBook in the past. It's a great tool. The only, my only concern here would be that PitchBook is extremely expensive. So if you are an early stage startup, it might be expensive to have PitchBook. But if you are working with an advisor, and if your advisor, has PitchBook, then, that may be one way that you could, leverage the database. Great. And then I've heard of a few others like Mattermark and whatnot, but I don't really have much experience with those. Um, Okay. And then I guess a couple of other questions. So, what would a typical due diligence process look like for startups?
well, it's some of what we had said as far as um, looking at the items that are in the pitch deck, really answering those questions. Doing some maybe background checks on the team, going through the documents, legal documents, company documents, reviewing the model in depth, doing a competitive analysis, looking at the IP. Um,
Hmm.
yeah, and it could
Okay,
be, obviously it varies from VC to VC.
got it. Okay, great. So another question is for hardware startups, right? So for hardware startups, especially in Silicon Valley, it's a little harder to raise money since a lot of investors seem to be very, SaaS focused and software focused. So do you have any specific recommendations for hardware startups in terms of, how much, how much time or how much time would the process take? How much traction should they have before they can raise a round? Um, and obviously, the process would also look a little bit different than SaaS startups.
Yeah, well, one way to approach it would be to maybe look outside of this geographic area as well, and maybe strategic because you've got all of the you have the Cisco, you've got different companies out there that where strategic might make sense, and but it may take longer, and obviously the more traction that you can show, or the better the idea, then that's gonna help you all that much more.
Got it. Okay. Then another question we have is for, and I'm not sure, if this squarely falls under, our topic of discussion today, but for essentially for real estate startups that are essentially, like building and buying real estate, is there any recommendation that you have for them?
I remember seeing several of them, um, starting a couple years ago. I guess so some of them are doing things different than others
Hmm.
in that space. It's a big enough space. I guess it's
Hmm.
sort of like the crowdfund. If you need any licenses, obviously you want to
Hmm.
make sure that you have all your ducks in a row because you don't want to. I remember being in some pitches and the moderator or somebody said, well, after listening to the pitch, well, yeah, that's illegal or something. You want to
Right.
be making sure that from a regulatory standpoint that you've got everything covered, and but it's just I think being differentiating yourselves. You don't want to copy what somebody's already doing unless it's just a huge market, um,
Yeah.
and you can maybe do it better. It's figuring out a different niche within that space.
Yeah. Okay. Great. And then a few questions are around Affine Finance that we have here. So a couple of questions are how do we get started with Affine Finance, and how would you, like how can they contact you? How can they work with you? I think the easiest way for the audience to get started is just either, fill out our form on our homepage, affine.finance, or, just shoot us an email at contact@affine.finance, and we can, essentially set you guys up. Um, I think we have one more question coming in. So, do you have any advice for a B2C early stage company that is trying to raise money? So, a consumer brand or anyone that's directly dealing with consumers.
Well, I would just see what the competitors are and then work backwards and see who invested
Hmm.
in them. Maybe
Okay.
get some traction.
Got it. Okay, great. Great. So I think we have a few more minutes left. I would love to actually give a brief intro on Affine Finance and who we are. So again, our email is right here down on the bottom left, contact@affine.finance. Just a couple of slides here, which I don't want to go through them, but just essentially glance through them. So this is us. This is all the services we provide, and fundraising support is what we are talking about today. Obviously, Bob is a fundraising expert, but as you mentioned, he can also, essentially be a part-time CFO and provide a few other services here, such as the, strategy consulting services. This is basically a little bit more on us. We have a pretty extensive selection process for our experts, and these are some of our experts. Their work experience. Some startups they worked with. We have a slide here which is essentially your typical fundraising process timeline. And Bob, I know we worked with you to essentially develop a little bit of this, so would love to get your thoughts on this as well. But again, this can vary widely. Like Bob said, it could be 3 weeks, could be 12, I mean, it could be 3 months, 12 months. But typically, if you're looking at like a 4-month process, this is how you would break down, your essentially your initial prep, creating investor materials and doing your due diligence, and then negotiation and closing the round. Great. And then again, if you guys want to work with us, you can just shoot us an email. If you have any questions that weren't answered on this panel, please shoot us an email, and we can go from there. Awesome. Thank you so much, Bob, for your time. And we will see everybody in our next webinar, which I think is next weekend. Thank you.
Thank you. Thanks, Aaron.
Thanks, Bob.